Hello everyone, my name is Majid Rahimi and you're watching the second video of Classical Technical Analysis course. You can also access the first video here. If you're interested in our videos and you haven't subscribed yet, you can click on subscribe button and notification bell under this video to get notified when our new videos comes in. As I promised, in this video I'm going to talk about the Dow Theory. So first we will look at its history, then we get to know about stock market averages, which is used in the Dow Theory, and finally we will survey the principles of it. I recommend you to take notes of this video to have a record for yourself. Let's take a look to the history of Dow Theory as the grandfather of all technical market studies. Charles H. Dow founded the Dow Jones Financial News Services in 1882, as you may have heard the name, even if you're not working with the market by now. He invented the stock market averages, and he's credited because of this. He wrote the basic principles of theory for the Wall Street Journal. 2 years after his death, William P. Hamilton took up Dow's principles and organized them and formulated them into the Dow Theory. Let's take a look at averages. The idea of having averages comes from the fact that the price of the securities of most companies tend to rise and fall together. This fact is not for past, and it's still true and always will be true. Charles Dow tried to express general trend of securities market by the average price of a selected few representative stocks. He set up and used two averages in his studies in 1897. 20 companies for railroad and 12 companies for industrial were making these averages. The number of industrial average companies increased to 30 in 1928. In 1929, all the stocks of public utilities removed from industrial and a new average of utilities was set up. Nowadays, an updated list of 20 rail, 30 industrial, and 15 utility stocks are averaged together to make Dow Jones Stock Composite. Dow Theory does not pay attention in utility or composite averages. It only cares about industrial and rail, which is known by transportation by now. Let's just take a brief look at these averages in TradingView. Well, here we are in TradingView website, which gives us lots of charts from many different brokers. You can access this website by typing this address in your address bar in your browser. So if you go to this website for the first time, you can see this page and you can launch chart by clicking here. The first chart which appears is this chart, which is for Apple Incorporation, and you can search the chart you want from here by typing the symbol or the name. It will help you to find what you're searching for. I want to show you Dow Jones Industrial and Dow Jones Transportation averages. You can search DJI here as the symbol, and you can see this chart. You can zoom out and have a wider view of this average. We also searched DTX for Dow Jones Transportation average,
and you can see the last value of this averages in this website. Okay, let's go back to the Dow theory itself.
Well, these are the basic tenets of Dow theory. The first tenet is that the averages discount everything. As the averages are made of whole market, everything that can affect supply and demand is covered by the averages. Even unpredictable natural disasters quickly show themselves in the averages. The second tenet is about three kinds of trends. In the Dow theory, we are working with three kinds of trends. Major or primary trends are the most great up and down movements, which usually occurs in 1 year or more and results more than 20% rise or fall in value. Secondary swings, which are retracements and corrections on the opposite direction of major trends. Secondary swings and interventing segments together are called intermediate movements. And finally, minor trends or day-to-day fluctuations, which are unimportant to the Dow theory. The primary trends are the greatest and largest up and down movements of market, either in duration or in value. They usually last for more than a year, sometimes several years. When the primary trend is up, we call it bull market. When the primary trend is down, we call it bear market. Bullish and bearish in other aspects of market come from here, and the main use of it is for this. The primary trends are what a real long-term investor cares about them. The secondary trends are the intermediate reactions that interrupt the progress of price in the primary direction, and they are always on the opposite direction of primary trends. If we see a retracement in opposite direction of the primary trend which meets these two conditions, we can say it's a secondary trend. 1. The retracement lasts for at least 3 weeks, and 2. It retraces at least 1/3 of previous net move in primary direction. They usually retrace between 1/3 and 2/3 of previous net move in primary direction. Let's see a graphical demonstration of how it works.
Imagine this is a part of one of the averages chart. If the amount of total previous movement was equal A, the first condition of recognizing the secondary movement is retracing 1/3 of A, and the second one is its duration, which must be 3 weeks or more. Detecting the secondary trend is the hardest part of the Dow theory, but as you can see, it's not that hard. The minor trends are only small fluctuations of market which usually last less than 6 days and rarely as long as 3 weeks. So if correction in the primary trend was less than 3 weeks or less than 1/3 of the value, we consider them as minor trends. Manipulation in market can only affect this trend, and they are not important in the Dow theory. A good example for these three trends in nature is tide, wave, and ripple of sea. Tides which are affecting the level of sea at most can show major trends, and waves are secondary trends. There are some small movements on surface of water or following the waves as ripples, which can be considered as minor trends. Imagine you are living near the sea and you have no idea of tide levels. A good way of measuring the highest level of water when it rises up is put a long piece of wood in the shore and mark the highest point which waves can reach them. If the next waves could reach higher levels, you can say that the tide is still pushing the level of water up, and if it fails to do so and went to a lower level, we can say that the level is in its maximum and the uptrend is finished. And we can also decide about downtrend in opposite view. The market has lots of differences with sea and tide levels, and it's not as predictable as sea is. We have no idea of where market is going to stop its movement while we know it about tides, but this simple concept can be used to label market trends. Well, this video comes to its end. In next video we will continue the Dow Theory principles, and then we will talk about some defects of the Dow Theory. Your comments would help me make better videos, so feel free to comment on every video, share these videos with your friends and colleagues or anyone you think that might need this information. Thanks for watching, have a good time, and bye.